Thank you all for coming. Hope your day is going well. So, as Jean had said, we're going to talk about life cycle of taxes. Presumably, everybody files a tax return and has taxes, in their life. So this is a subject that's, familiar to everybody. The three different kind of taxes we'll talk about tonight will be, and it'll be the next. Good. See, she's already on it. Income taxes, and basically tax on your income. Capital gains, which would be sale of assets that would then present capital gains. And then property taxes. So there's a whole different cycle of that. So first-time home buyers, and she touched a little bit about this. Everybody's reluctant to, if you're a first-time home buyer, to go out there because you say, oh my gosh, interest rates are high. They're in the 5s and 6s. And I remember my first house in 1980 was a 10% loan, and when I went to sell it, I got overbids because it was an assumable loan. At that time, they had loans that you could just kind of take over. So I had my house sold for a little bit more because it was assumable. So 6% loan, even though it's high compared to what it's been the last few years, it's still something to be considered in terms of first-time home buyers. So tax strategies, a couple of things. First of all, when you don't own a home, or if your home is paid off, so you got both ends of the spectrum there, generally speaking, you're probably going to be better off doing a standard deduction. In other words, what the government gives you as deductions will probably be more than your property taxes. And the exception to that is if you have a lot in charitable donations, then you'll probably still itemize. Okay, but for a first-time home buyer, they're generally not going to be itemizing because they're stuck with the 10% SALT deduction for taxes. They've got no mortgage interest, and again, unless they have charitable donations, they're going to take the standard deduction. Certainly, buying a house, and certainly at rates of 6% or more, it's going to present them with some mortgage interest that's going to help them with regard to itemizing deductions. Now, the strategy's always been with my clients is when they're, for a first-time home buyer, and basically for anybody who's buying a new home, you would figure out about how much deduction you'll get and what the tax savings will be on those deductions. And then what you can do is translate that into exemptions on your W-4 so that you can ask your employer to take less taxes out so that you have more cash flow to help you pay for the new mortgage that you're about to have on your new home. It's a little bit more dicey now doing that because the W-4 is a different form than it was 4 or 5 years ago. But the strategy itself still applies to where if you're a first-time home buyer and you want to increase your cash flow to help you make these larger mortgage payments, presumably you're going to be paying more in mortgage than you were in rent. This will help soften the blow until you kind of figure out and get your legs with regard to the payments and your lifestyle. So those are strategies for first-time home buyers that will help you. Next slide, please. Okay, so again, when you're itemizing deductions, whether it's a first-time home buyer or not, you have 5 classifications of deductions. You have medical, you have taxes, interest, mortgage interest, charitable donations, and the miscellaneous category. So generally speaking, most people will be in the taxes, mortgage interest, and the charitable donations. So for a first-time home buyer or anyone who owns a home and has a mortgage, you have mortgage interest. First-time home buyers, a lot of them will find that they'll need mortgage insurance if they're only putting down 3 or 4% on a mortgage, on a down payment. So you have mortgage insurance, and there's a potential deduction for the mortgage insurance part of your payment. The other one is you have points, or loan origination fees. So when you're buying a home, the points are going to be deductible. if you're refinancing your home, the points are not going to be deductible. With that, okay, there we go, perfect. So the points will be deductible if it's your original purchase of your home, but not on a refi. Now, if you do, as we did years ago, we were doing one refi after another as the rates were dropping. We told our loan guy, we'll just keep our information and just keep rolling it over. If you're going to pay points and you refinance, and then you refinance again, and you pay off the loan that you just refinanced, then your points are deductible, okay, because it's a new loan. Okay, so that's one thing to remember. So for first-time home buyers, they'll have all these new deductions. The other one is what a lot of people are thinking, especially first-time home buyers, is the residential energy credit. If you have solar, right now solar, I believe, is 30%, which is really a good deal. It was 22 for a couple of years. It was 30 before, and now it's back to being 30. I don't know when that's going to sunset, so that's something to remember. There's also in the works, if you're running a business through your home, you will get potentially a home office deduction. Now that's whether you rent or own anyway. So, but people miss that. If with COVID, a lot of people were starting little businesses at home. You do get a deduction for your home office, and so that's another good one. Now, for another one for first-time home buyers, it's not law at this point, but it has been. I think it passed one part of the House, but not the Senate. It was a first-time home buyer credit, but as of now, it's not law, so we'll just kind of skip that. Okay, so, and we're touching upon this whole thing of first-time home buyers. You have the whole thing of renting versus owning, and for some people, for most people, they probably want to own, but the constraint is they probably don't have enough down payment, or with interest rates rising, they just don't qualify because now the percentages that they need of income to support loans just isn't there. But there are folks that decide that they just really want to rent. They don't want to buy. They don't want to have to maintain the home. They don't want to have to bother. And that's okay. That's a lifestyle that they choose. And then the other side of it is people struggle. They get into the home. And all of a sudden, this is an asset that will appreciate over time. As we know in San Mateo County, the appreciation over a long period of time has been very good. And this is how people build estates. And the people who own the home would say to the people who are renting, well, each month you're writing a rent check, but you don't get anything for it. Yeah, and then the others would say, well, your mortgage payment's twice as much as my rent. And so, this is the kind of discussion back and forth. But generally speaking, people, I think, if given the choice and did qualify, would probably want to own a home and begin to, get their estate going. When I say their estate, their assets over time. So they're, for many folks, their largest asset is their principal residence. So that's how that starts. Okay, investment property. So obviously people buy homes to live in, but there's also, I've had a lot of clients over the years could not afford to buy a house in this area. They didn't have enough down payment, the houses were too expensive. So what they would do is they would buy rental property in another less expensive area to at least get in the market and allow, again, some appreciation to take hold, and then 3, 4, 5 years from then, they would sell that property, take those capital gains, pay them, and use that money now as a down payment for their own home. So that's one strategy that if you can't buy a home for whatever reason in this area, there are other things that you can do. Okay. So the IRS treats ownership of a rental piece of property as a business, okay? So you need to keep good records, rental income, all the different expenses. So the IRS, this is why people you should always keep good records with regard to rental property because it is a business. Now, the main difference between a business that you may have selling products or services and owning real estate is that the net income from owning real estate is not subject to Social Security tax, FICA, which is really huge. So I mean, that's one benefit of having a rental property. And obviously, the other is that, again, the appreciation you're able to take over time. Now, when you have a rental piece of property, I guess the next slide. When you have the rental piece of property, there are deductions that you can take. So we mentioned, obviously, rental income, but you've got mortgage, taxes, and insurance are your basic 3 deductions that you have on a rental piece of property. But obviously, you have advertising, you have management fees. If you don't want to manage it yourself, there's a lot of people who shouldn't own property and rent and manage it themselves because they're just not that mentality. So they have managers who do that, and that cost is deductible. Repairs, as I mentioned, supplies, if you have legal issues, even like with regard to your CPA or your tax preparer, a part of your fee that you get charged for doing taxes should be classified as going against part of Schedule E rental because he's spending time and that's part of your tax return. I routinely do that for when I was doing taxes for my clients. Yeah, okay, good. So other expenses, that you may have travel to and from your rental property. And this applies to a lot of people who have, like I mentioned before, for people who either want to diversify geographically, what they do is they buy out-of-state property. So I had a client who owned a property in Utah, Oklahoma, Texas, all these different places. And they would periodically go out and talk to the managers regarding the property, and this travel was deductible because it's an ordinary and necessary business expense with regard to this business of owning real estate. Okay. Now, for many, the largest deduction that you will have when you own real estate and rent it out will be depreciation. So when you buy a piece of property, the first thing your accountant will do is they will ask you, well, how much did you pay for the property? They'll probably want to see the closing escrow statement. And what they'll do is they'll determine, the split between land and building. Some accountants use the property tax bill to determine the percentage of land versus building. The land is not deductible as depreciation. The building is. So it behooves you to kind of keep those records, keep that escrow statement. But depreciation will probably be one of your larger deductions. A good rule of thumb, and rental real estate that's residential will be at 27 and a half years, and rental real estate that's commercial will be 39 years. So big difference between the two. Let me see here. Yeah, and as let's just say you buy a rental piece of property and things start going, appliances start going, well, okay, you're going to buy appliances and those will be depreciated, and under the laws currently, those are depreciated 100% in the first year, okay? Now, one other thing to consider is, this doesn't happen very often, but it's becoming very popular. It's called cost segregation. And what that says is there are engineers who are able to take your purchase price of your home, of whatever home you're buying and renting out, and they can slice and dice it into not 27-and-a-half-year property, but 5-year property, 7-year property, 10-year property, 15-year property, a piece of it. And those parts are 100% deductible in year one. So if you have a situation where you need heavy depreciation because of large amounts of income, rental and otherwise, you may consider cost segregation as a solution to that. We'll talk about a little bit later a situation regarding changing a principal residence into a rental property and then selling. But I think this is a good place with regard to our discussion on depreciation to say this. So you buy, like I bought my house in 1989, and we've done all kinds of stuff to the house, a little bit here, a little bit there. And let's just say that we decided we're going to move, somewhere else, and we're going to rent our property out. Well, the first thing your accountant's going to ask you for is, what's the cost basis of your home, of your principal residence? Well, if you've lived there all these years, you don't really even consider that. You just think, wow, okay, well, I don't know, I paid so much for it, and I did this and that. All that to say that if you decide that you do want to rent it out, and even if you don't decide you want to rent it out, but you want to sell it, you're going to have to come up with your cost basis, and that would be your original purchase price, refi costs, improvements, and if you're going to do improvements, like let's just say that you've owned a house for 30 years and you've remodeled the kitchen twice. You only take the last remodel, you don't take the first one. You only take the last roof, you only, but I would say to you, go and look at each room and look at that room and say, what have I done to this room? When did I do it? How much did it cost? And put those numbers together, because you will need them sometime in your life, unless you pass away with the property and you get a step up in basis. Then you don't have to worry about all this stuff. It's a great tax planning tool, but it's not good for some. So this is a good part to say that you want accurate depreciation, and you can't turn your house into a rental and then 2 years later say, gee, I forgot about this, that, and the other thing. You've tipped your hand to the IRS with regard to what your cost basis is. You can't keep adding to it, from year to year. So anyway, that's something to consider that you can do now with your principal residences. And what I suggest is doing like an Excel spreadsheet and just adding lines, having it be a living spreadsheet, adding lines as you go, and you make improvements. If fixtures, whatever it is, keep adding to it, and at the end you hand that to your accountant, and they will love you, because it's a historical piece of evidence as to what your depreciation should be. Anyway, enough of that. Okay, other possible benefits, as we spoke about before. We're talking still about owning rental piece of property. No FICA. And in 2017, we had the large tax package that was passed under Donald Trump. And the one big thing about rental property that came out of that was that the law allows a 20% deduction for rental real estate, ownership of businesses, income from S corporations and partnerships and LLCs. So if your rental property is in an LLC, you still get that, as long as you have positive income. And there are limitations with regard to other income that you have, so you may be limited, but that's a huge, huge deduction. And what it was, the purpose of it was that he had lowered the corporate rate from 35% to 21%. So he wanted to make a parallel for individuals who don't have large corporations and who could benefit from the lower taxes. So he came up with this 20% deal, and it's actually worked out really well. And it's still in law today. Okay. Okay, so the next little slide is, oh good, here we go. Buying alone versus buying with others. So I've had this happen many times where you've got two or three clients, two or three people in the same family. They can't individually buy a property, but they could buy a property if they pool their monies together. Now, it takes a special family to do that, because it does present some issues. Some cultures it really works out well, others not so well. So that's another thing is that you can buy with others and buy properties that you would probably never qualify for on your own. But again, you need to look at the risks involved, the relationships involved, so on and so forth. But it is a viable alternative. Now, if you decide, we'll talk about 1031 exchanges in a second, but if you decide that you have a rental piece of property and you just want to sell it, that's fine. So you'll have capital gain when you sell it. There'll be two parts of capital gain. The first one is recapture of depreciation. So that's taxed at 25%. So to the extent that you've taken depreciation over the years, you have to pay a little bit more tax on that because you got ordinary deductions in those years. Now you'll pay back capital gains. And then when that recapture has been, capital gain has been paid, then the rest of it will be at the 20% tax. Now, behind all this is another 3.8% tax, they call it the Obama Medicare tax. So that's on investments, interest, dividends, capital gains. So if your income exceeds certain levels, then you may be hit with that 3.8%. So when someone asks me, well, I'm going to sell my rental property, what's my percentage of tax to be? I always tell them it's going to be around 35% because I'm figuring on 20% federal, about 9.3% California, and I throw in the 3.8% investment. I don't necessarily, build in the 25% recapture of depreciation capital gain. I just leave that alone. But usually 34 to 35% is right. It's a little over a third. And the other thing to consider in California is California wants their money up front. Okay? So when you sell a rental piece of property, the California Franchise Tax Board asks your escrow company to take 3 1/3% of the gross sale price and send it to them. So what do they do with the money? They take the money and they give you a credit. So when you file your tax returns that next year, you'll take a credit for those taxes already paid to the state of California. You may have overpaid and you may have underpaid. The alternative, by the way, to this is, let's just say you have a rental piece of property you only own for a year or two, and you just need to sell it. And you really didn't make, that much money, but you had some capital gain. What you can do is you can have your tax preparer or yourself go ahead and fill out it's called a 593. It's a California Franchise Tax Board form. And it actually goes through and computes what you estimate your gain to be, and then they take 12.4% of that. So 12.4% of your actual gain might be much, much less than 3 1/3% of the gross sales price. So that's just another thing to consider. Okay, 1031 exchanges. What's a 1031 exchange? So the law allows you to sell your investment property, and in doing so, you have two choices. You could just pay your income tax and move on, or you can do what's called a 1031 tax deferred exchange. And I mean the word deferred, it doesn't eliminate tax, it just defers it, kicks it down the line. So the principle is this. You have 45 days from the day your rental property closes to identify property that you want to buy in its place. And then you have 6 months, 180 days, truly, from the close of escrow to actually close the property. So, and what happens here is that, all along the way, and by the way, if you have any inkling of doing a 1031 exchange with your real estate, your rental property, you need to tell your real estate agent before the property ever goes on the market, because they need to inform any buyers that they're going to be cooperating in an exchange. No sweat off them. There's some papers to sign and that's about it. But they need to know that they're cooperating in the exchange, and their agent will hopefully explain that correctly to them so they know it's no big deal. But you don't want to spring that on a buyer halfway through escrow. It just doesn't work very well. Okay, so basically, as long as you, and the rule is this, as long as you use all of the cash proceeds and you buy as much property as you had sold, then your exchange should be fine. Okay, there's a lot of iterations to that. You know, you have to have as much mortgage. You can have a little bit more mortgage if the price of your house is more. But the basic rule is that if you use all the money and you buy as much house, then you can't go wrong. And when you are in escrow, you will hire what's called an accommodator, a 1031 exchange company. You can't do this yourself. Your agent can't do this. There are licensed people who do this. You need a third party, basically. And there are a lot of good ones out here. In fact, I did a seminar a couple of years ago with Ron Ricard. We had a great time at that seminar just going through. He was going, because he does the practical of it. He's probably done 10,000 exchanges in his life, literally. So they will help you through all of these kind of nooks and crannies. Now, a couple of tricks. Let me see here. Give me a second. Okay, that's fine. Yes, that's done. Also, oh, good. I'm past that one. Okay, so, and we'll get to the tricks in a little bit. So, what properties qualify for a 1031 exchange? Obviously, rental property, land, commercial property, actually, leases that are, I think, over 50 years. I mean, there's a lot of things that actually qualify for 1031 exchanges. What doesn't qualify? And that's the next slide. And that would be, development properties. Why does it not qualify? Because those people that is their business. They file a Schedule C, not a Schedule E. Swap properties that you're doing. And principal residences don't qualify for 1031 exchanges. And vacation homes don't qualify for 1031 exchanges. Why? Because they're not bona fide businesses. Okay? Okay, so a couple of tricks that people, a lot of attorneys think about and accountants do is, if we can defer taxing something into a future year, that really helps because we can plan. So let's kind of take a 1031 exchange. Let's just say that you're selling your principal residence, your rental property, and you find a buyer, and it's July 15th. Okay, so if it's July 15th and you're going to set up to do a 1031 exchange, and for whatever reason you can't find a property, but you've identified it and all that, that exchange won't actually complete until 6 months later, which puts you into January of the next year. Okay? So in January of the next, and all along, the property closes because the buyer wants to move in. They don't care about what you're doing with your exchange. But what happens to the proceeds? The proceeds go into this fund that the accommodator takes care of, and he holds the money. That's the whole thing of an exchange, is you can't touch the money. If you touch the money, it's called boot, and it's taxable to you. Okay? So let's just say that you can't do anything and you go into January. Now we have an opportunity. And the opportunity is this. You didn't receive any funds in let's say, 2022, even though your property closed probably sometime in August. You received your funds in mid-January of 2023. Well, that's called an installment sale because you're receiving payments in multiple years. So you're able to decide whether you want to report that capital gain on your 2022 return or your 2023 return. So what I do in those situations is I tell the client, hey, if you're going into escrow and it's June 28th or something, ask the buyer if they can actually have the close be in July, so that we can, if you're going to do this exchange, at least you have this possibility of straddling the years. And then what I do is I have the person, we usually file an extension like in 2023, and that gives us till October to file the 22 return. And by October of 23, we know which year is the better year to have that capital gain take place and save a lot of taxes. These are like little gimmicks that really help. And it may not mean anything to you now, but sometime in your life, if you're going to do an exchange or you're going to sell a rental piece of property, these are the things to think about as you're doing it. And you can talk to your tax accountant, and they can help you through it. And if he doesn't know or she doesn't know what's going on there, ask Gene for a copy of this seminar, because it'll be on tape, right? Yeah, and pop to the part where we're talking about this, and then show that to them, and maybe they'll figure it out, and you can go from there. But a lot of times, many accountants don't know this because they don't deal in real estate a lot. Okay. All right. So 1031, okay, so 1031 exchanges are interesting in that they can help you in different parts of your life to accomplish things that you want. So let's say, for instance, you're getting to retirement age and you have 3 or 4 pieces of rental property and they're driving you crazy, and you say, in retirement, I don't want this, okay? Well, what some people choose to do is they sell the property, they do an exchange, and instead of having 4 little single-family dwellings, they find one piece of property, larger piece, maybe commercial, maybe not, and it kind of makes their job a little bit easier. Yes, you've got all your eggs in one basket as opposed to the 4, but it's just a matter of simplicity. Or let's just say that you have one large commercial piece of property and you're getting up there in age and you have 3 or 4 kids, and you want to leave these kids their own property. So you can do an exchange and sell the one property and buy 3 or 4 properties, so that when you pass away, you could write in your trust that this property goes to kid number 1, that property goes to kid number 2. So as you can see, the 1031 exchanges can be used in many different fashions to kind of help you, whatever your plan is, whatever your thoughts are, your family status and all that, that will help you to determine how to use 1031 exchanges. Also, if you are, and a lot of people do this too, they'll do an exchange where they sell a piece of property and they buy a much more expensive piece of property, obviously leverage it, mortgage on it, and in doing so, they get a new depreciation schedule for that additional amount. Yeah, and I failed to say that when you do a 1031 exchange, what happens is the capital gain, the gain that you have in that property will be passed over to the replacement property that you have. So let's just say you sell the property for $1 million and it had a gain of $400,000 built into it. And you buy another property for, say, $2 million. Well, what we'll do is we'll take the $2 million and we'll subtract the $400,000 of capital gain that you're deferring, and now we'll be depreciating $1.6 million. So that when you sell that second property, it will already encapsulate the gain from the first property that you deferred. Okay. All right, so relocation. And this has become more popular in the last 10 to 20 years. So let's just say you have a piece of property you've lived in for 30 years, you paid $400,000, and it's probably worth, $2-3 million. So what do? If you sell it, you've got, $2 million of gain, roughly, using our 34%, and we've got about $680,000 in tax. So what do? Well, one strategy is to, and by the way, you get your $250,000 each. If you're single, $250,000. If you're married, you each get $250,000 if you both qualify. Most people do. That's a given. But let's just say that you want to do something else rather than just paying the $680,000 in tax, because that just doesn't seem, like a fun thing. So what you can do is you can convert your principal residence into a rental piece of property. And generally speaking, a 1.5 to 2 years of renting it is long enough. There was an IRS revenue ruling that said 2 years. The law doesn't say anything regarding that, so it's gray, but let's just say the 2 years is very safe. And then between the second and third year, not after you begin renting it, but after you move out, between the second and third year, you sell the property. Well, at the point that you sell the property, it's not a principal residence anymore. It's a rental piece of property, so you can do a 1031 exchange. However, at the same time, the law regarding the $500,000 exemption says that if you've lived in your house 2 out of the last 5 years, then you qualify for the $250,000 each of exemption. So in converting your property to a rental and then selling it, say, 2.5 years later, you basically get both of those. You get the 1031 exchange, and you could actually pull $500,000 of cash out of there if you're married, and $250,000 if you're single. So that's a really great strategy that people use to kind of bridge it. And so what happens is that you get your $500,000 out. Let's just take the property. We talked about $2.5 million piece of property. You take your $500,000 out if you're married. So now you've got $2 million that you have to reinvest. You find something else to invest the property, maybe 2 or 3 pieces of real estate, maybe a piece of commercial real estate, and the gain is deferred into that other property, and you've got your $500,000 out, which is a great thing. Now, what I've had some people do is they'll buy 2 or 3 pieces of property, and what they'll do is they'll buy a piece of property in the area that they'd like to go in. So let's just say they have a place here in San Mateo County, and they want to move up to, say, Roseville. So part of the exchange will be to buy a property up in Roseville, and they'll continue to rent that property out, because remember, a 1031 exchange is rental for rental. And maybe a couple of years later, they move into the property. That's okay to do. And if they live in that property for another 3 years, because you have to keep 1031 exchange property for 5 years before you sell it, they'll be able to get another $500,000 of exemption. Excuse me. Let me see, option 1, yeah, so we've gone option, yeah, so we've gone through most of that, basically, move out, yeah. I'm sorry? Oh, okay, option 2. Oh, okay, so there's an option 1 and option 2. Option 2 really doesn't happen very often, but it still needs to be mentioned, and it's this. Let's just say you have your principal residence and you rent out part of your residence, you rent out some rooms, or you use part of your principal residence and take a home office deduction. Well, when you sell your principal residence, in theory, the part of your residence that you rent out, the percentage of it, that part does qualify as a 1031 exchange. I've never been really excited about this, because how do you defend it? It's really kind of hard, but it is part of law that you're able to do that. So that is another option with regard to, not having to pay 100% of the tax, because you could defer part of it in a 1031 exchange. All right, so other options. We mentioned the 5-year rule. And obviously the other thing to do is, if you move out and move up to Roseville, you could still just rent your property out. And I tell that to people. My advice has always been that if you think you want to move to another area, don't sell your property. Rent it out and go to that other area, rent for a year, see if you like it. 50% of the time they don't like it and they move back into their property. Okay? Because the minute they sell their property, they're never coming back to San Mateo County. It just isn't going to happen. But I do have some people who go up there and they like it. They like the area, but they don't like the place they rented. So now they've been up there a year. They've scouted out the area. They know they want to live. And then they have the decision to make regarding, doing the exchange or just outright selling their property. Because remember, and we'll get to it in a little bit, but if you sell your property and you're over 55 years old and you have a real low tax base here in San Mateo County, you can transfer that tax base up. You can do that 3 times in your life. So there are a lot of considerations, but none of those considerations matter if you sell your property and move up there and then decide you don't like it and you want to move back. So my advice has always been, don't sell your property till you know for sure you want to be up there. And by the way, I've had clients who did the move out and then they rent the property out and they intend, between years 2 and 3 to sell their property and do an exchange. I've had many clients that say, you know what? I love my renters. I love the rent I'm getting. That's my hardest working asset that I left there. I'm not going to worry about the capital gain, the $500,000, the 1031 exchanges. Thanks for all that advice, but I just like keeping my property in San Mateo, San Mateo County, and that's it. And we'll probably die with it, and we'll get a step up in basis. Again, great planning tool, and that works real well for them. So, but all of the advice I'm telling you, all these little stories I'm telling you, it's all about keeping your options open. It's all about, waiting a little bit longer, being patient, and allowing things to happen so that you can make informed decisions over time rather than, selling the property and really losing out on potential benefits. Now, there was a time when, people, and we were part of this too, where we decided, we liked where we were, and I've had a lot of clients who had this situation. They liked where they were. They wanted a bigger home. They're getting some kids and all that kind of stuff. So the thought came up is, should I sell my property and buy a larger home, or should I just improve the property that I'm in? It's always a discussion that every family is different. I tell people, listen, when you sell your property, you potentially are going to lose, 7, 8%. It used to be more like 10, but it's not as much anymore. So let's just say that you're selling $1 million piece of property. So you've got $70,000 to $80,000 potentially, coming and going, selling that property and buying the new one. $70,000 or $80,000 of cost. Okay, so $70,000 or $80,000 of cost. That might be 25% of your equity in the property. So we say, okay, would you rather do that and get the larger house, maybe in the same area, or can you take that 80 grand and use it to improve your house? See, these are the kinds, again, keeping your options open, thinking about these things over time. And there's no right answer, there's no wrong answer. Everybody's answers everybody's situation is different. But I just, I hate to walk away from, 25% of my equity when it can go into my house. But a lot of times what people opt is they want to get they want to sell their home. They don't want to go through a remodel because they've, heard of all the, horrors about doing that. And that is true. There are, depending on who you're getting to do your work, it could be a problem. And it is easier to just sell your property and buy another in the area. The issue regarding that, though, and the other consideration is property taxes. So if you're, say, 50 years old and your property has gone from, $400,000 to $1.5 million, and you say, okay, we need a bigger home. Let's sell our house and buy another one. Well, when you sell your house and buy another one, even for maybe 1617, your property taxes are now going to be based on the 1617, whereas you just had a house where it was based on 400,000. So again, these are considerations to have and think about before you do them. Okay. You can, if you wish to, buy a rental piece of property or a part of an LLC that owns a rental piece of property through your retirement plan. So let's just say you have not your 401k, it would be more like your IRA. There are third-party administrators who you can hire and put your IRAs in them, and then you can self-direct them to actually buy a rental piece of property. Now, it's not as simple as you think, depending on who your third-party administrator is. And the other consideration is this: whenever you're going to use your retirement plan to buy a rental piece of property, it has to be cash. You can't have any loans. Because if you have a loan on that piece of property, it becomes subject to what's called unrelated business income tax, which means that your retirement plan may have to file its own tax return and actually pay income tax. So you don't want to do that. So if you're gonna have your retirement plan buy a rental piece of property, then it has to be cash. And this is where you may decide to, find a piece of property with 2 or 3 other people who you can trust. You form an LLC, the retirement plan monies go into it, and you buy the property with that. All right, let's talk about property taxes. Go ahead.
We're starting to run a little low on time.
Oh, we are. Oh, gosh. Okay. All right. I'll pick and choose here. So property taxes, basically, under Prop 13, your property taxes are based on, I think, 1976 values. They go up 2% a year, okay? And again, property taxes won't go up more than 2% a year, and as long as you don't sell the property, then your property taxes will only go up to 2% a year. Also, if you make improvements to your property, to the extent of those improvements, your property taxes will also increase. Now, when you do some minor, let's just say you get a permit and do a little bit of improvements to like a living room or something, be careful that the county doesn't reassess the whole house, because I've had friends where that happened, and it's not right, and you need to call them on that. So be careful about property taxes being increased too much. Okay, so when we passed Prop 19, a couple of years ago, I guess, maybe 2 years in November, one of the things was that you can have your property tax. If you sell your property and you go to another county in California, you will be able to take your property taxes with you. For a long time, that wasn't possible. There were only cooperating counties, but now it's forced to do that. Now, again, if you're over 55 years old, or you're disabled, or a victim of the fires or whatever, you will be able to sell your property and move your property tax to those other counties. And that's what's called portability. And you can do that 3 times in your life. It is 3, yeah, 3 times in your life. So if you're going to move around that much, as long as it's in California, you're okay. Yeah, and we talked about eligible homeowners. We talked about this just now. It's 55 or older or disabled. So it used to be also that, if you sold your property and you bought a more expensive property, that you were not able to carry your property tax over if it was more than 5% or 10%, depending on when you did it. Now with Prop 19, no matter how much more you pay for your property, you are able to go ahead and take your property tax and roll it into the new home, and the difference in value between what you bought and what you sold, that difference will also be added. So if you sell a $1 million house and you buy a $2 million house, you're going to add $1 million of assessment to whatever your house was previously assessed. Very simple, and it makes it a lot easier than what we had before, which is you had to go through a 1-year rule and a 2-year rule. Okay, so Prop 19 also threw some curveballs into estate planning. So really the two things regarding estate planning that you need to know, the first one is if you have a principal residence and one of your children will move into that principal residence, then that child will retain your assessed value with a $1 million exemption above the assessed value that there is already. So let's just say that you have a house, and there's an example here, house worth $200,000 that you bought, your assessed value is $200,000, is worth $1.8 million. Okay, so the child gets the $200,000 exemption, $200,000 assessed value plus $1 million of exemption. So they'll actually end up with, I believe, $800,000 of new assessed value. How do we come up with that? It's the $200,000 assessed value plus the exemption of $1 million, so that's 1.2. The difference between 1.2 million and 1.8 million is 600,000, so that's our increase. And then that 600,000 plus the original 200,000 is where we get the $800,000 assessed value. So it does help, okay? Now, if you have a principal residence and nobody's going to move into it, they're going to rent it out, or if you have other rental pieces of property, those will all be reassessed at date of death. So that's kind of the downside that really nobody really knew about in Prop 19, or else I don't think it would have passed. Okay, so we talked a few times about, or I talked a few times about step up in basis. So there's a difference between the income tax aspects and the property tax aspects. So when somebody passes away, their property, all property is stepped up to the date of death value of the property value for that date. Now, that's for income tax purposes, that's for capital gain purposes, that's for depreciation purposes. That's not for property tax purposes. Property tax is a whole different thing. So you're either going to get assessed to the date of death value if it's just a rental piece of property given to kids, or you're going to have the principal residence situation where it's not going to be quite as bad. But I'm just trying to make the distinction between the step up only being a federal and state income tax issue, not a property tax issue. If you want to get, how are we on time? We're good? Okay, all right. So the other strategy that some use is to say, let's just say you have a large commercial building and you want to, give it to your kids, give part of it to your kids now and later, give it to them when you pass away. So you can put that commercial piece of property into an LLC. That would be step one. And then what you would do is you as the parents would retain 51% of that property, at least 51%, and you would gift the rest of it to the kids. Now, it does a couple things. One, it allows you to take discounts because you're not giving any one of the children a marketable piece of property. They own a percentage of an LLC interest which underlying owns a piece of property. Okay? So you could normally take up to, say, 30-35% discounts. What does that mean? What that means is that if you have like a $2 million piece of property and you're giving, 45% to your kids, that's a $900,000 gift. So if we take a $900,000 gift and during our lifetime, at present, we can give, I believe it's $11,700,000 away without having a state tax, okay? I know that the current president wants to lower that to somewhere between 2 and 3 million instead of 11 million. That would be a problem if you're giving these large gifts. So what you want to do is preserve as much of your estate exemption as you can. So these discounts allow you to stretch and give more rent, more property and more assets to your kids without having to pay estate taxes either now or later. So that's what the discount's all about. And so going back to our example, so now the parents own 51% or whatever percentage over 50, and the kids own a piece of it. So why do 51%? Well, the state law says that as long as 50% or more of a property in an LLC has not changed interest, then you don't have to reassess the property. So you can give that percentage of the property to your kids and there's no reassessment. However, when the parents die, they'll get a step up in basis on the 51% that they own, not on the part that they gave the kids previously, and the property will be reassessed. So it's a temporary thing, but again, depending on how young you are and how the kids, it may be years and years of savings regarding property taxes, kind of a way around Prop 19. And I think that's it. So I know that's a lot to swallow, and hopefully you'll walk away with one or two things that you didn't know that will help you and spark your interest, and maybe you have a question. So we'll get to that. Okay, so basically the question was, if I'm doing a 1031 exchange and I have a property in California, can I buy a property in Colorado as my exchange property? And the answer is yes, it doesn't have to be in California. And I'll tell you why a lot of people do that. In California, when you buy a piece of real estate, the split between land and building is usually about roughly 50%, especially in the cities. Maybe in the country it's more like 60-40. However, there are many states where the split between land and building is 90-10. For instance, in Georgia, in Colorado, in Oklahoma, in Texas, those are 90, and the 90% is the building. So you could see that by doing an exchange into property in these other states, your depreciation will be of value to you against cash flow. So that's why people do that. Step up in basis applies to any asset that you own, not only real estate, stocks and bonds, anything that you may own, art. And when a person passes away, all those assets are revalued at the date of death value. And it's not something, a step-up basis has nothing to do with something that takes place during a person's life. It's only when they pass away. And a lot of times when you have a couple, a married couple, and they have a living trust, when the first one passes away, the remaining surviving spouse, as we call it, will receive all of those assets at the date of death value. So they will benefit from that. The question is, should I put my principal residence into an LLC? My answer is no. It's not necessary. You may find attorneys that want everything into an LLC. They love LLCs. I would say to you, if you have other assets along with your principal residence, buy an umbrella policy. Because think of the LLC. If you put something in the LLC and there's a problem with that asset, whoever the problem is with can take that asset if it's in the LLC. What happens is the LLC is formed to protect everything outside the LLC. So if you have a rental piece of property in an LLC and something goes really sideways and you're sued and they can take that property, but they can't take your other assets because they're not in the LLC. So I don't see the real benefit from having your principal residence in an LLC. When is the best time to start thinking about giving property to your kids prior to death? I think that's the full question. It's impossible to tell, and I don't mean to skirt the question, but here's the thing. Depending on your situation, your age, your kids' ages, all those factors are taken into account with regard to when it's a great time to start giving things to your children. The first thing you need to consider is your care for life. So you don't want to give properties or any assets, cash, prematurely because you might need it for your care. Okay? But depending on your situation, your net estate, there are perfect situations where it's great to give property to kids prior to death, to use your exemption. We talked about the discounting, but every one of those situations are different. There is no right answer to that because everybody is different. So what's the downside to that situation where you set up an LLC, you keep 51, you give 49 to the kids? The only real downside that I could see is that when you pass away, the 49% that you gave to the kids earlier does not get a step up in basis. That's it. So depending on how long you're going to own that property, you may or may not decide to do that. You may decide to keep the property individually, and just when you pass away, the kids get 100% basis. Especially with Prop 19 now, they're going to get reassessed. So there's really no savings there. So the question is, how do I use the home office? All right. So there's the presumption that the home office is used for a trade or business, products you're selling, services you're providing, internet or whatever. And it's not just that you're an employee, because employees don't get home offices. And you can use a part of your home office for your rental piece of property management, but that's not the home office we're talking about. We're talking about a home office for a legitimate business. And what happens there is that what the law says is that the part of your home that is exclusively used for your business, that square footage divided by the total square footage of the house, that becomes your home office percentage. Then you can multiply that by your real estate taxes, your mortgage interest, your cleaning, your utilities, your insurance, your alarm system, whatever it is. That's where your home office is there. Yes. So you can have, and I actually mentioned that, I think, to where you start an LLC and you've got 3 or 4 people that, on their own can never buy the property because it's cash. Remember, you're buying it, no loans. But 4 or 5 people might go into the, put their investment retirements into the LLC, and then the LLC itself buys the property. Really no depreciation benefit there because the LLC doesn't pay income taxes. So what's the benefit of doing that? It's an asset that grows, and later on when you sell it, you don't have to pay capital gains because presumably the money is going to remain in the retirement account. So that's the benefit from doing that. I have one more thing to say. So I'm also a trustee in different trusts that I've worked with. And in all of the trusts that I've worked with where there's been a sale of residence, I have been very happy using Jean. And she's been wonderful. And the families that I've had to work with have not always been so easy because you've got 4, 5, 6 kids and they don't all agree on things. And it drives me crazy. But Jean was perfect in working with these families, doing a wonderful job, I think every escrow we've worked with, everybody was completely happy, and that's just my life experience in dealing with Gene. So.